Please welcome Sherry Berenbach, who is our chair for this session. Sherry Berenbach is Director of Microenterprise Development at the U.S. Agency for International Development and is based in the United States.
Good morning, everyone, and welcome to this second day of the summit. We have a particularly interesting panel this morning where we'll be looking at some of the important challenges that are facing our field. And the discussion will be focused on a paper entitled Challenges to the Field and Solutions: Over-Indebtedness, Client Dropouts, Unethical Collection Practices, Exorbitant Interest Rates, Mission Drift, Poor Governance Structures, and more. As we can see, as our field has been maturing and growing, there are an increasing number of challenges that we are seeing before us. The presenting author of this paper is Anton Simanowitz, who is the founder of Imp-Act Consortium in the United Kingdom. And we have a number of esteemed panelists that include Tilman Erbach, who is the CEO of the consultative group to assist the poor, or CGAP, in the United States. Wolde Amha we are hoping will be joining us shortly. He is the director of the Association of Ethiopian Microfinance Institutions in Ethiopia. Roshana Safar, who is the managing director of the Kasha Foundation in Pakistan. And I'm sorry to say that Fabiola Cespedes Quiroga, who is the social performance coordinator of Foro Lacfra services in Bolivia. Unfortunately, she was not able to get here in time and will not be able to join our panel today. Let me remind our delegates that the paper we're about to discuss can be found in the book New Pathways Out of Poverty that was placed in your registration bag. In a moment, I will ask our author to take 10 minutes in total to summarize the paper, and that will be followed by discussions from the panelists, each of them speaking for about 8 minutes. After these remarks, we will go into questions and comments from delegates in the hall. Those who wish to pose a question or comment to our panelists should write the questions down on their notepads, and then you'll be told to pass those questions down to the Center for Collection at a later time. So you do want to, as you're listening to the discussion, if there are questions that come to mind, please do note them so that you're ready when we are collecting the questions. Well, with that, let me ask Mr. Simanowitz to take no longer than 10 minutes and to give us the highlights of his paper. Thank you.
Good morning, everyone. Good morning. Let me start with a question to you. What's the one thing that you know for sure about the clients of microfinance? It's that at some time they will face an emergency that they find it hard to cope with and which requires a sum of money larger than their income. So poor people have small and irregular incomes, and they find it really hard at short notice to pull together a sum of money to cope with illness, for funerals, for natural disaster and other emergencies. In Haiti, for example, I worked with a program of Foncaise for the extreme poor, and I was really surprised to find out when I interviewed the clients that the women had not been mostly in extreme poverty all of their lives, but actually had fallen into poverty as a result of a family illness. So poor people are vulnerable. Whilst they may invest in a business, whilst they may improve their situation, at any time that could be wiped out, and they can fall back down the slope into poverty or even destitution. So how do MFIs respond to this reality? Well, sadly, all too many MFIs focus on getting their money back rather than helping their clients to cope. And I would argue this is not only bad for clients, but this is bad for the MFIs themselves. So my message here today is that whilst there are many good MFIs doing fantastic work, there's a widespread failure to take into account the vulnerability of clients in the design and the delivery of microfinance services. And this, I would argue, lies behind many of the negative outcomes and the problems that we are seeing in microfinance and hearing reported globally, and such as the harsh collection practices, such as over-indebtedness and the other issues in the paper. So for me, it's the combination of three factors which act like a pressure cooker, providing no release for clients when things go wrong. First, many MFIs still provide only credit for business, with inflexible loan terms, with poor timing of loans, and little recognition of the reality of the need for services that help clients cope with their other financial needs and with emergencies. Second, when things go wrong for clients, they have no way of responding, and clients are required to continue repaying their loans as if nothing has happened. In the case of group lending, for example, there may be support from group members, but many organisations have long abandoned solidarity, or the solidarity in the group is ineffective. Third, many MFIs apply a policy of zero tolerance to late repayment. They implement incentives to ensure high repayment rates, and they turn a blind eye to what happens behind the scenes to ensure this. So, for example, in India, we hear of MFIs that deduct any arrears from the loan officers' salaries. Of course, they achieve a 100% repayment rate, but at what cost to the clients? Here's a little cartoon I found on the internet. So it sounds obvious that hounding a client who's experienced a catastrophe for her repayment makes no sense. But many MFIs sadly are doing this. And it's not just a problem in markets such as India with excessive competition. This is something that we're seeing worldwide. Last year, for example, I attended the operations meeting of an MFI I work with in South Africa, which is strongly poverty-focused. And the operations team were together discussing a problem of arrears. So the ops manager instructed the team, I want this solved quickly, next month, be here. Arrears gone. No more arrears, please. Come back next month. So I asked the question, how many of these arrears are can't pays? And how many of these arrears are won't pays? Oh no, said the operations manager. We hardly ever have won't pays. No, we form our groups well. Our clients are serious. No, people aren't repaying because they've experienced an illness or their business has collapsed. So how do you solve a problem of arrears in a month if it's due to business collapsing or illness? Well, it's simple. You put pressure on your zonal managers, who put pressure on the branch managers, who put pressure on the loan officers, who put pressure on the clients, who go to a money lender, take the money, or they sell their assets and they repay the loan. Let me tell you another story. Last February, I was delivering a training in East Africa for 5 MFIs, and one of my messages in the training was to ask participants to think about how do they help their clients reduce their vulnerability, how do they help their clients cope with emergencies. Helen Lutega, the CEO of a MFI in Tanzania, Belita, who I think is here today, I'm not sure. Helena? So she started thinking about a particularly troublesome case of arrears that she was facing. So Lucy Alfred was a good client. She was running a successful business. She was repaying her loans, she was growing the business, she was having no problems with the organisation. And then disaster struck and her business was burnt down. So like many MFIs, this is a picture of Lucy. Like many MFIs, Belita has a system focusing on zero tolerance for non-repayments. They don't restructure loans. They have no emergency loans. They have no insurance. And the savings that clients have are small, and they pretty much held as security against the loan. So for 6 months, the loan officer put pressure on Lucy to repay her loan, even though her source of livelihood was destroyed. So on the return from the training, Helena called Lucy into the office. And she said, Lucy, we've decided that we're going to restructure your loan and we're going to provide you additional capital to restart your business. and Lucy broke down in tears. She explained how she had expected to be arrested on going to the office. She'd even told her family, look, don't expect me home tonight. Go to the police station and find out what's happening. She'd been at the point of despair, not knowing how she was going to survive and repay her loan, and she'd even been considering selling her land, the source of future security, livelihood for her family. So I met Helena six months later, and she explained how, after this restructuring of the loan and the recapitalisation, Lucy had returned to being a good client, her business was flourishing, she'd repaid the loan, she'd cleared the arrears. Not only that, she was going around the community telling everybody how helpful Belita had been to her. So these examples show how the financial pressures in microfinance can potentially harm good clients. But what's really shocking to me is these are two examples from MFIs that are dedicated to reducing poverty through microfinance. Helena, a CEO with 15 years' experience, applies what she sees as the only way to do things, i.e., zero tolerance to late repayments. So recognizing the problem is half of the solution. I really, in my experience, in my research for this chapter, I can see that we have the knowledge, we have the experience to make microfinance more effective. The challenge is to apply it. So how do we build microfinance that builds resilience and helps our clients cope when things go wrong? Well, the first step is to have the right products and services, to get our services right. We know that productive use of credit, designed around clients' needs and capacity to repay, can help increase income and assets. We know that sometimes credit alone is not enough, and that training, marketing, access to new products can add value. We know that our clients struggle to manage their day-to-day finances and pay for anticipated needs such as electricity, water, school fees, and longer-term needs such as weddings. And we know that accessible savings, loans, remittances can help, but so can financial education. We know that when things go wrong, secure and accessible savings can be drawn on. Insurance, emergency loans, and remittances can also provide access to money when it's needed. We know that supportive groups can often cover each other's loan repayments or lend money to pay for hospital fees or to restart a business. But supportive groups don't happen by accident, and there's a lot that MFIs can do to facilitate that. Finally, we know that when things go wrong, none of this is enough, and MFIs need to respond in a flexible way when things go wrong. So MFIs, such as the Grameen Bank and many others, are developing carefully managed processes to restructure loans when clients need that. Clients must demonstrate the commitment to repay, and this is not an easy way out, and those deliberate defaulters are still pursued. So, in conclusion, my message is that this is not just about serving clients better, it's about building stronger organisations. Clearly, if we help our clients manage their risk and we reduce the risk to them, we reduce the risk to the MFI. A couple of years ago, I was teaching at the Boulder Microfinance training course, and the person who teaches the risk management course asked to audit my training. At the end of the week, she came up to me and said, "Do you know, this course has really opened my eyes. I teach the entire risk management course, and I never mention clients." So for me, one of the key challenges is to open more people's eyes to the reality of our clients and how this affects our organisations. I'm optimistic because I sense a renewed sense of energy and commitment and interest in this summit and in the industry. The Social Performance Task Force, the SMART campaign, the Seal of Excellence, many other initiatives are really focusing on how do we ensure that microfinance not only works in a responsible way that doesn't harm our clients, but that we focus on how to be more effective. At last, people are understanding that not all microfinance is good and that the outcomes are not automatic. If we want results other than just getting more loans to more people, we need to care about quality. We need to design our services with our clients in mind. So I'm optimistic. I'm optimistic that as a community we have the knowledge, we have the experience to make microfinance work for more people more of the time. but we need to apply what we know. And above all, we need to focus on understanding and responding to our clients' needs. So thank you.